The science of investing, exploring the principles of growing your money. Investing is a mix of art and science. While the art involves making smart decisions and following your gut, the science of investing is about using proven principles and data to make better choices. In this article, we'll explore the science side of investing, breaking it down into simple terms. By understanding the science behind investing, you can make smarter decisions and potentially grow your money more effectively. The foundation of investing, risk and return example. Let's say you have $10,000 to invest. You can choose to invest it in a high-risk stock that has the potential to double your money or lose it all, or you can invest in a low-risk bond that offers a steady but lower return. Understanding the risk and return trade-off helps you decide how much risk you're willing to take based on your financial goals and comfort level. 2. Market efficiency and the role of information example. Imagine you have insider information about a company that will release a groundbreaking product soon. You might be tempted to invest heavily in that company, hoping to make a big profit. However, market efficiency suggests that such information is quickly incorporated into stock prices, making it difficult to consistently outperform the market solely based on inside information. 3. Modern portfolio theory and asset allocation example. Modern portfolio theory suggests that by diversifying your investments across different asset classes, such as stocks, bonds, and real estate, you can reduce the overall risk of your portfolio. For instance, if one asset class experiences a downturn, the other assets can help cushion the impact and potentially generate positive returns. 4. Trends in sustainable and impact investing example. Sustainable and impact investing involves investing in companies that prioritize environmental, social, and governance (ESG) factors. For instance, you may choose to invest in a solar energy company that contributes to renewable energy production and reduces carbon emissions. This allows you to align your investments with your values while potentially benefiting from the growth of sustainable industries. The rise of quantitative investing and artificial intelligence example. Quantitative investing relies on mathematical models and data analysis to make investment decisions. For instance, a quantitative investor may use historical stock price data to identify patterns and trends, helping them make informed decisions on when to buy or sell stocks. Artificial intelligence-powered robo-advisors use algorithms to create and manage investment portfolios based on an individual's risk tolerance and investment goals. Understanding the science behind investing can help you make smarter decisions with your money. By considering risk and return, being aware of market efficiency, diversifying your investments, and keeping up with trends like sustainable investing and AI, you can increase your chances of growing your money. Remember that investing always carries some risk, so it's important to do your research, seek advice when needed, and align your investment choices with your personal goals.